Imagine waking up, logging into your bank app, and seeing your life savings completely wiped out by a massive IRS penalty. And the craziest part? You triggered it yourself just by moving your own money. But wait, how can moving your own cash actually destroy your retirement? If you're over 60, shifting funds between the wrong accounts is no longer just a simple errand. It's a fatal trap that triggers immediate, devastating taxes, and nobody is going to warn you. Not your bank teller, and definitely not the IRS. So, what exactly is this trap? Today, I'm exposing the exact bank transfer you must never make after age 60. Plus, I'll reveal the 100% legal loophole you should use instead to keep the government's hands off your cash. Seriously, do not touch a single penny of your retirement money until you finish this video. Welcome back to the channel. If you're new here, hit that subscribe button right now because we expose the hidden financial landmines the government actually hopes you'll step on. You've worked hard for 30 or 40 years. You sacrificed, you saved, and you finally built up a decent nest egg. But is it safe? Now that you're nearing retirement or you're already there, you're probably thinking about moving that money around. Maybe shifting an old 401k to a new bank with better interest rates, or consolidating a couple of IRA accounts. Sounds completely harmless, right? I mean, it's your money. You should do whatever you want with it. Wrong. The exact second you initiate this specific type of transfer, the IRS activates a silent alarm. I call it the checking account death trap, and it is brutally efficient at draining your wealth. Innocent retirees are literally losing tens of thousands of dollars overnight without even realizing what they did. Let's step right into the danger zone and see how this nightmare unfolds. Say you have $100,000 sitting in a retirement account. You decide to move it to a different bank across town. So you call up your broker and ask them to send you your money. Big mistake. You tell the broker to send a check to your personal checking account or just wire it directly to you. Your plan is super simple. Hold the cash for a few days, then deposit it into the new account. In the financial world, this is called an indirect rollover. And spoiler alert, it's absolute financial suicide. Why? Because the moment that money hits your personal checking account, the IRS jumps to a wild conclusion. They automatically assume you are cashing it out to buy a Porsche or go on a wild trip to Vegas. And because they think you're spending it, Uncle Sam demands his cut of the pie instantly. By federal law, if you do this indirect transfer from an employer plan, that financial institution is required to withhold a massive 20% for taxes immediately. They take it right off the top before you even see it. Yeah, you heard that right. You asked for your $100,000, but you only got $80,000. The IRS basically acts like a mafia boss, taking a 20 grand protection fee before you even cross the street. Now, you're probably sitting there thinking, relax, I'm just moving it. It's not a big deal. I'll put the whole thing in the new retirement account next week. Well, here comes the trap. This is where the steel jaws snap shut on your finances. The IRS gives you exactly 60 days to put the entire original amount, the full $100,000, into the new retirement account. Sounds easy enough, right? Except, remember that little math problem we just talked about a minute ago? You only received $80,000. The IRS is holding your other 20 grand hostage. To complete this transfer legally and dodge the taxes, you have to come up with that missing $20,000 out of nowhere, out of your own pocket. Let me ask you, do you have 20 grand in cash just lying around? Most normal retirees do not have $20,000 in spare cash just chilling under their mattress to cover a phantom tax bill. So what happens when you can't magically produce that missing cash? The 60-day clock runs out, and the second it does, the IRS goes in for the kill. Because you missed the deadline to deposit the full $100,000, the IRS now reclassifies your innocent little bank transfer. They officially label it as a massive, fully taxable distribution. Your own money just became your biggest liability. But hold on, the nightmare is literally just starting. Imagine staring at your calendar watching those 60 days tick down to zero. You're calling your bank, you're calling your CPA, and everybody is giving you the exact same terrible news. You are stuck in a bureaucratic nightmare, and there's no customer service manager you can complain to. It's like stepping on a financial landmine, freezing in place, and realizing nobody is coming to defuse it. The government literally engineered this system to capitalize on your innocent mistakes. They are banking on the fact that you won't read the fine print of the tax code. And honestly, who reads the tax code? It's thicker than a Harry Potter book and infinitely more depressing. But ignorance isn't bliss here. It's a one-way ticket to going absolutely broke. We'll get to the domino effect that destroys your Social Security in a second. It's mind-blowing. Suddenly, that entire $100,000 is added straight to your yearly income. It artificially skyrockets your earnings on paper and aggressively pushes you into a much higher, more punishing tax bracket. But wait, it gets so much worse. Let me explain the brutal domino effect that's about to crush your budget. First off, because you suddenly look super rich to the IRS. A massive chunk of your Social Security benefits will suddenly become completely taxable. You are literally getting penalized twice for the exact same money. It's like getting a speeding ticket and then the cop steals your car tires just for fun. Make sense? Second, this fake income spike triggers something called the Medicare IRMAA penalty. It's an acronym that basically translates to the government legally robbing you at your doctor's office. Are you ready for the craziest part? They look at this inflated income and permanently double your Medicare premiums. For an entire year, your Medicare Part B costs will shoot through the roof. By simply moving your own cash through your own personal checking account, you just created an absolute financial disaster. You could easily lose 30 grand, 40 grand, or even half of your life savings to taxes and penalties. Your hard-earned savings are just gone, vanished into thin air, all because of one innocent bank transfer that nobody warned you about. The system is rigged to capitalize on your honest mistakes. So how do you actually fight back? How do you protect yourself and move your money completely safely? How do you shift your funds without letting the IRS touch a single solitary penny of your retirement? You must use a 100% legal loophole known as the Direct Trustee-to-Trustee Transfer. Write this down because this one strategy is going to save your entire retirement portfolio from complete annihilation. Here is the golden rule. Never, ever let the check be made payable to you. When you want to move your money, you must instruct your current broker to send the funds directly to the new bank. The check or wire transfer must be made payable to the new financial institution, but strictly for your benefit. For example, the check should literally read something like Fidelity Investments, FBO, John Doe. FBO stands for benefit of. This is the magic phrase that keeps the IRS completely out of your business. When the money moves directly from institution to institution, it never touches your personal checking account. Why does this matter? Because the IRS 20% withholding rule simply does not apply here. The ticking 60-day time limit, it doesn't apply either. It is a completely invisible transfer as far as the taxman is concerned. Your savings remain fully intact, perfectly protected from taxes, and safely deposited into your brand new account. But hold on, do not click away just yet. There is one more sneaky trap you must be aware of before you even think about calling your broker to move your funds. Even if you manage to do everything right, the IRS recently cracked down on a totally separate hidden rule. It's called the one rollover per year rule. If you do more than one indirect rollover in a rolling 12-month period across all of your IRA accounts combined, you are completely screwed. The entire second transfer is immediately taxed. It cannot be reversed, and you can't just say, oops, my bad. The government makes these rules incredibly complicated on purpose. They are practically begging you to screw up so they can tax your hard-earned money and fund their own endless spending habits. That is exactly why you must always consult with a certified tax professional before touching any of your retirement funds. If this video opened your eyes and helped protect your savings today, do me a massive favor. Hit that like button right now, so the YouTube algorithm shares this urgent warning with other seniors. Share this video with your friends, your family, or literally anyone you know who is over the age of 60. And please don't forget to subscribe to the channel for more urgent financial updates. We are fighting back against these hidden government traps together, one video at a time. Thanks so much for watching. Keep your money safe, and I will see you in the next video.